Video wrote a check to the wrong person. Or maybe you set up a recurring payment for a subscription you forgot to cancel and it's about to drain your account again. Can you actually stop it? The answer is yes, but only if you know the rules. And here's the surprising part. Most people get this wrong because the rules for stopping a paper check are completely different from the rules for stopping an electronic payment. Miss the deadline, use the wrong words, or forget to follow up in writing, and your bank can legally let that payment go through anyway. Today, we're breaking down exactly how stop payment orders work under federal law, so you never lose money to a payment you thought you'd already stopped. Welcome back to Money Regulation Hub, the channel where we take confusing financial rules and turn them into simple, practical knowledge you can actually use. I'm your host, and today we're tackling something almost everyone deals with at some point, but very few people fully understand. Stop payment orders. By the end of this video, you'll know the difference between stopping a check and stopping an electronic payment, how long a stop payment order actually lasts, what it costs, what your bank is legally required to do, and what happens if your bank messes up and pays anyway. We'll also cover real scenarios, a bounced business check, a canceled gym membership that kept charging, and a fraud case, so you can see exactly how these rules play out in real life. Stick around, because the section on oral versus written orders alone could save you a very expensive mistake. Let's start simple. A stop payment order is an instruction you give your bank telling them not to honor a specific payment before it clears. Think of it like calling off a delivery truck before it reaches your door. Once the truck arrives and drops the package, it's too late. The transaction is done. The same logic applies to money. Once a check clears or an electronic transfer processes, a stop payment order can't undo it. There are two major categories you need to understand because federal law treats them very differently. The first is paper checks, which fall under state law based on the Uniform Commercial Code, specifically Article 4, though this framework operates alongside federal banking regulations like Regulation CC, which governs how quickly banks must make funds available and how checks move through the system. The second is electronic fund transfers. Think automatic bill pay, recurring debit card charges, and ACH transfers, which fall under a specific federal regulation called Regulation E, which implements the Electronic Fund Transfer Act. Why does this split matter to you? Because the deadlines, the required paperwork, and even how long your stop order stays valid depend entirely on which category your payment falls into. Let's say you wrote a check for a used car, but the deal fell through before the seller cashed it. Under Article 4 of the Uniform Commercial Code, which every state has adopted in some form, you have the right to stop payment on that check. Here's how it works in practice. You can give the order orally, over the phone, for example, and it's valid for 14 calendar days. If you want it to last longer, you need to confirm it in writing within those 14 days. Once you do that, the written order is good for 6 months, and you can renew it in writing for additional 6-month periods indefinitely. Here's a common mistake people make. They call the bank, feel relieved, and never follow up in writing. 2 weeks later, the stop order expires, the check gets deposited, and the money is gone. If you're stopping a check, mark your calendar the moment you make that call. Your bank will also require specific details, the check number, the exact amount, the date, and the payee's name. Why? Because the order has to describe the item, quote, with reasonable certainty, and it needs to arrive with enough time for the bank to actually act on it before the check is processed. If you get the amount wrong by even a few cents, some banks may not catch it, and the check could still clear. So double check your check. There's also a fee involved. Banks typically charge a stop payment fee, often somewhere between $15 and $35, though this varies significantly by institution. It's not regulated at a fixed federal rate, so it genuinely pays to check your bank's fee schedule before you assume it's free. Now let's flip to the world most of us actually live in. Automatic payments. Your streaming service, your gym membership, your car insurance auto draft. These fall under Regulation E, and the rules here are actually more generous to consumers in one important way. Timing. Under Regulation E, if you have a pre-authorized electronic transfer, meaning a recurring payment set up in advance, you can stop it by notifying your bank at least 3 business days before the scheduled transfer date. That's your deadline. Give them at least 3 business days notice, and they're required to stop the payment. Here's where it gets important. If you give that notice orally, your bank can require you to follow up with written confirmation within 14 days. If you don't send that written confirmation, the bank's obligation to keep honoring your stop order may end. So just like with checks, a phone call alone might not be enough long-term protection. Let's walk through a real-world example. Imagine someone named Jordan signs up for a monthly meal kit subscription. After a few months, Jordan decides to cancel, but the company keeps charging their debit card anyway. This happens more often than people realize. Jordan can go directly to their bank, not just the merchant, and request a stop payment on that specific recurring charge. As long as Jordan does this at least 3 business days before the next scheduled charge, the bank is required to block pocket, even if the merchant never processes the cancellation on their end. That's a powerful consumer protection tool that a lot of people don't even know they have. So you did everything right, you gave proper notice, you followed up in writing, you hit every deadline. But the bank messes up and pays the item anyway. What now? Under both the check rules and Regulation E, if a bank pays over a valid timely stop payment order, the bank can be held liable for the resulting loss. For checks, this generally means the bank may have to recredit your account for the amount of the check, though you typically need to show you suffered an actual loss because of the payment. For electronic transfers under Regulation E, banks that fail to honor a valid stop payment request can be liable for actual damages, and in some cases statutory damages and even attorney's fees if it goes to litigation. That said, this isn't automatic free money. Banks will investigate, and you'll likely need to show proof. Your stop payment confirmation, dates, account statements. This is exactly why documentation matters so much. If you call your bank, ask for a confirmation number or a reference number for that call. If you submit anything in writing, keep a copy. These small habits are what separate a smooth reimbursement from a drawn-out dispute. Let's talk about a few gray areas that catch people off guard. First, debit card purchases that aren't recurring. A one-time swipe at a store generally cannot be stopped the way a check or a recurring payment can. Once that transaction is authorized, the money is typically already earmarked to leave your account, even if it takes a day or two to formally post. If something's wrong with that purchase, you're usually looking at a dispute or chargeback process instead of a stop payment order, a completely different mechanism. Second, cashier's checks and certified checks are much harder to stop than a personal check. Because the bank has already certified the funds are good, most banks will only cancel these under specific circumstances like proof of loss, theft, or an indemnity bond, since the bank has essentially already guaranteed payment to whoever holds that check. Third, timing genuinely is everything. If your stop payment request arrives after the check has already been processed or the electronic transfer has already been initiated, the bank has no legal obligation to reverse it. This is why acting quickly, the moment you realize you need to stop a payment, genuinely matters more than almost anything else in this entire topic. Let's bring this all together. Paper checks are governed by state adoption of the Uniform Commercial Code. An oral stop payment order lasts 14 days, and a written order lasts 6 months and is renewable. Electronic and recurring payments are governed by Federal Regulation E, which requires you to notify your bank at least 3 business days before the scheduled transfer, with written confirmation needed if you gave notice orally. In both systems, banks can charge a fee for processing your request, and that fee varies by institution. If a bank fails to honor a valid, timely stop payment order, it can be held responsible for your loss, but you'll need documentation to back up your claim. And finally, remember that one-time debit card purchases and certified checks play by different rules entirely, so don't assume every payment can be stopped the same way. The single most important habit to walk away with today? Always follow up in writing, and always act as early as possible. Those 2 things alone will protect you in almost every stop payment scenario you'll ever encounter. That wraps up our deep dive into federal and state rules on stop payment orders. If this video helped you understand your rights a little better, do me a favor and hit that like button. It genuinely helps this channel reach more people who need this information. If you haven't already, subscribe to Money Regulation Hub so you don't miss the rest of this series breaking down the financial rules that actually affect your everyday life. Drop a comment below. Have you ever had to stop a payment and did it actually work? I'd love to hear how it played out for you. And if you know someone who's dealing with a runaway subscription charge or a check they need to cancel, go ahead and share this video with them. It might save them some real money. Next time on Money Regulation Hub, we're covering something just as practical. The federal rules around overdraft fees and the recent changes that could put money back in your pocket. You will not want to miss that one. See you in the next video.